Good morning, everyone, and welcome to Secret Sauce 365 podcast, where we answer the questions that business owners ask themselves every day. I'm your host, Stan Hladek, and I am honored to welcome Cardie Saunders IV, better known as Cardie Saunders, one of the best entrepreneurs I've ever met. So, if we're going to get answers to business questions, then this is the mind we want to pick this morning. So welcome, Cardie. Thank you for being here. Why don't you share a little bit about your background for our guests?
Sure. Just to give a little background. So first, thanks, Stan, for having me. It's great to be here, and I haven't heard my formal name used in a while. I think it's a challenge.
Still on the birth certificate, right?
Exactly. It's in there somewhere. But yeah, so my background's a little bit different one. I started in corporate America. I worked for United Technologies, and I was starting the strategic planning office and moved into product marketing and started in my first kind of M&A stint, my first promotion when I got moved. I moved them a couple times physically. I was with the company for 6.5 years right out of college. Got to do some executive MBA work while I was there and cut my teeth in corporate America. It was a great learning experience. And was able to move into some exciting stuff. Got to do some M&A projects as we were buying our distribution businesses back then in the mid to late 90s. It was a strategy modeling after the Coca-Cola bottling angle, which ultimately we ended up buying them all. Shortly thereafter, within the same company, was VP of sales and marketing. So I was running a large group. We were doing about 170 million in sales. So I had 4 sales managers and dozens of sales guys. So I was used to running a sales team, and we had to run the entire marketing budget. So I was a sales and marketing guy, which is still my favorite thing to do of all the things I've had to do since. Then I got recruited out of there, did a turnaround. So I got to work with private equity for my first time. I was running a turnaround situation, president of a company that was a Northeast distribution company with 17 locations that was bleeding money. And got that to break even and sold it off in pieces. And then after that, got to move on to my first, what I always wanted to do was be an entrepreneur. So that was my foray into learning what it's like to wear the president's hat and in a very tough situation. So I was well geared and healed to deal with the entrepreneurial market. So went out, did my own thing. I've been in a lot of businesses, small businesses, anything from real estate to green cleaning technology companies, manufacturing businesses, distribution, some small turnarounds. Ultimately then founding my own company called eTemp, which I had for 11 years. Started from scratch. Apologies for the dog in these times.
No problem. Everybody's welcome on the Secret Sauce.
Hey, what are we going to do? This is the new world. So anyhow, got going on a 11-year journey from startup scratch. Started it with, my partner and I started the $800 plane ticket and went off and did that enterprise, grew it and sold it eventually in December 2017. It was by the end, we had global agreements with Hilton and Starwood and McDonald's and a bunch of great companies that were buying our products to save energy in their commercial equipment. So it was a great business. I learned about how to do an exit, how to sell my business. Learned a lot through that process as well. You learn something new along the way. And then, of course, along those same times, I've owned and still own a lot of different businesses. I'm an advisor on many, some of the board of some companies, own some real estate, quite a bit of real estate I've accumulated over the last 15 years. And shortly after selling the business, I got involved with a great private equity firm called AEA, where I've been helping them build one of their portfolio companies through acquisition. And what started as a single business manufacturing controls and pumps for the leisure water business, we've now purchased, I've sole sourced 7 deals, which we've bought over the last 2 years, ranging in size from $1 million in EBITDA to $15 million in EBITDA. And brought those all together into one giant platform company in kind of a unique way, doing a little bit different than most folks do it, in leaving the companies truly standalone, but benefiting from having ownership structure where the founders get 80% cash at closing, 20% equity roll into the larger deal. So there's an incentive to work together without being told to work together, and because they're all partners now. So it's kind of a neat approach to private equity and what we're doing. So I've been doing some of that buy side advisory. In addition to that, I've been doing some consulting. Even though the buy side advisory work is quite time consuming, like you, Stan, I'm addicted to family and work, my two favorite things. And so I
Yes.
spent a lot of my time doing it. I just love helping people. And so I've worked on a couple engagements as an advisor for people selling their companies, also a lot of sales and marketing advisory work. So I'm actually taking on engagement now with the company to help them restructure their sales and marketing.
So, that's what this podcast is all about. See, man, it's about helping people and business owners. So let's start from the beginning. I appreciate all the background, and it lets our listeners understand the breadth of different businesses you've opened and been in and merged and closed, et cetera, et cetera. So let's just start from the very beginning. If someone's a business owner that has an idea and wants to start up, what are the couple things they need to think about right away as they're getting that EIN number and opening their business?
Yeah, I think, look, starting a business is the hardest thing you could possibly do. I recommend for most people, the first step, and hopefully they've already taken that, is to get experience from someone else on someone else's dime first. I attribute my time at United Technologies to that. I got to cut my teeth on someone else's dime. And, I launched my first business at 30, which I guess by today's standards might be old, but I think cutting your teeth in someone else's time is good because there's a lot to learn from a lot of smart people that have been around a lot longer than someone in their 20s.
So
Once
surround yourself with advisors, whether it be good accountant, good attorney, get the right advice so you build a solid foundation from the start.
Absolutely. So yeah, get your own experience first, but then when you do it, bring in the advisors and one of the most important advisors you can get, and it could be anybody, but it should be someone that's going to be on your advisory board or something that doesn't, cares about you, wants to see you succeed, has maybe a little upside in it, but nothing crazy, but wants to see your success because there's no agenda, right? I think some key, like you mentioned, some key vendors are important too. Obviously, attorney, accountant, insurance, of course, is important. But even someone like, obviously, not to pad the host here a little bit, but someone like yourself, Stan, is a good example of someone that would be a good advisor to join because not only do you have expertise in a specific field, but you run your own company. And so, whereas, it's one thing, I'm sure there's lots of great insurance people have a lot of great insurance expertise, but they also often hadn't had the burden of what it's like to be janitor to CEO when you're the owner. So I think that's a good thing.
Such a great point. I remember when I created The Secret back in 2015, two things I want to hit on that you mentioned is one, I had a solid plan and I brought you in from the consulting side, so you helped consult as to the structure, how we would set up the team, the contracts with the different carriers and all those things. And we laid out a 5-year business plan, which, very grateful we've succeeded on. But the reason I think that helped me the most is I meet regularly with 10 other agency owners, right? Insurance business people who've owned an agency for far more years than I have. And I pick their brains every month. So to our listeners out there, get involved with your peers in the industry. They may be your competitors, they may be your friends, but if you can, and not reinvent the wheel, if you can follow other people's success path, that's, I think, what Cardie's saying, right?
Absolutely. Yeah. And I think there's no reason why you can't do that. And I make your point about the competitors too, is, when you're younger, you think that everything needs to be yours, right? And you need to, maybe I shouldn't talk to this person. It's so, most people aren't looking to steal every idea you have, you can talk to people. It's safe. You share a little bit with them. They share a little with you. Everyone takes something away.
Yeah. Everybody has their guard up, sometimes too much. And you block out some good information or things that could really help you succeed. So let's move on. Like, the business is successful and some people have a plan to grow it and grow their team. What are some of the ways that they should focus on, so that maybe the growth is not too rapid and that their structure keeps up with their business plan? And do you have any advice in that area?
Yeah, it's I've always been biased to sales. I've always been a philosophy, and that's, again, my background of coming through and seeing too much burden on operations. But sales sales cures a lot of woes. So I think anything you could do to support the salespeople, whether that's software. I use some great software products for cold calling. Anything you do to reduce their bandwidth. Salespeople, without overgeneralizing, tend to be bad at organization. Tend to be bad at keeping track of certain things. So if you can come up with some solutions to support those folks, I think you grow your business faster. Obviously, there's the other side of it would be, of course, making sure you have the staff in place that your people can do the work. So whether it's software or back-end staff, supporting the salespeople so that they have the ability to do that. And if you're an entrepreneur starting your own business, odds are you're the sales guy, right? So you're usually the chief sales guy. It's the most likely a path to success. So if you can do that, that's the way to go.
So let's stick on that salesman or woman piece for a minute. You've been through many businesses. Can you share with our listeners some ways that you've provided an incentive for the salespeople, whether it was giving them some skin in the game or bonus structure plan? Maybe touch on that.
Yeah. So, obviously we've done, the straight commission plans, but I always try to make it mirror. I run a very open kimono with what I'm doing with my team. So I draw the line that, hey, here's the path that we're on. Here's how my company and me make money. So if you want to, I make sure to parallel them exactly to me. So if it's all about, EBITDA margins for me, then I'm driving them to do the same thing, right? I don't just take a sales guy and tie him to just gross sales. I try to tie him to something so there is an incentive maybe for him to look for cost cutting and not just close deals at any price, right? So there's a value there to me. So why not incentive him to do the same? I do the same even with my operations people. Obviously, it's a much lower amount because they're tied to base salaries, and that's more important to them. But I give them a tie to performance that, hey, if I close deals, even though they had nothing to do with maybe the work and the relationships or anything that happened, they're getting some sort of a taste of that so that they can feel that just that they constantly get this concept that it's all about the sale. Getting someone to come on board, getting a customer to trust you is important. So I'll reward them with that. And again, it doesn't have to be big. You might have an assistant or a receptionist, someone that it might be $100 gift card, but it's tied to something that the company gets to success for, and they get to taste a part of that.
Yeah, that's great. And it's good for morale. Transparency, I feel, is always good for morale. And, from the standpoint of our listeners, not every sale is a good sale. Something I picked up on that you said is you're not just trying to close a deal just to bring in the top line, because if it's an unprofitable deal to the company, what have you done? Right.
Right.
Yeah.
Yeah. So we time to that. Got to time to that.
So let's bring the structure, now towards the tail end, because I don't want to miss out on your breadth of knowledge in mergers and acquisitions. So what does a business owner do when his exit strategy is maybe not a continuity plan and he's looking to sell? Maybe some of our listeners right now, do these current times. So talk a little bit about regular mergers and acquisitions, Cardie. I know you have extensive knowledge in this area. So I'm looking to sell. What do I do?
So look, I think there's it's an interesting world what's going on with M&A, I think, all the time. So I think if you're looking at what you're going to do in your future, there's not a bad time. Everyone has this vision of, I want to sell my business. I want to suck it for all I can, grow it, take all the profits out, and then I'm going to sell it when I'm 65, and then I'm going to retire. The problem is you're leaving a lot of value on the table when you do it at 65. There's sort of everyone, if you talk to a trader or a wealth advisor, they're going to tell you can't time the market. And the same can be said about M&A. But I can tell you this, that at 65, the buyer is a little less likely to buy you unless they're strategic in nature. By strategic in nature, I mean they're someone that's going to buy you and merge you in. They don't need you anymore. You're going to be retired. They're going to close your business. They're going to pluck out what they want. And it's okay. Sometimes that's the right way to sell, right? But for a lot of people, they've built their legacy. They've built their staff's like family. When the time comes where they don't want to do the business anymore, they don't want to just see it die and fade away. So my recommendation is get involved with a partner earlier in that process. Don't wait till you're 65, because you're still valuable at a younger age. So, if you look at something at, in your 50s, you might say, okay, maybe I could partner with someone while I'm doing well, and I could still structure in a way that I can get not only some chips off the table now, but I can get some big upside going forward. As an example, in the deal that I'm working on currently that I'm doing with AEA, our partners that we're buying are getting, it's flexible, but let's call it 80% in cash. The other 20% of upside could end up equaling as much as the 80% they got in cash. Now they have to wait 3 to 5 years to do that. But for some of them, what's the big deal? You're 55, you're 57. It's not a big deal. You're still working hard. Got a lot to bring to the table. And you've eliminated the risk of having to put all the capital in. I know when I've owned my own business, there were 10 things I wanted to do. Maybe I did 3 because I can't afford to take the risk. And, as an entrepreneur and a person, you're always balancing, do I want to take the risk of my business? Do I want to go on that big vacation? Do I want to buy that second house? Do I want to take that extra risk? Whatever the things that you're looking to do, there's only so much you can do, and you're constantly doing that balancing act as an owner. And I think if you look at as when it comes time to sell, don't wait till it's too late. You want to do it while you're strong, physically healthy, the business is strong. Don't wait for kind of to squeeze every last ounce out of it, because you can do just as well on the exit post sale if you're still the CEO.
Yeah, you want to sell at the peak, I think, is something that I took out of what you were saying is when you're really rolling. And that's a tough call because sometimes you don't know when your peak is, right? But that's
you can't totally go for the peak. And you want to sell when it's up and the business is strong, but just like the wealth manager said, you can't time the market. No one can tell you exactly when the peak's going to come. And the same thing with your company. And I saw that happen, this year, right? So the businesses were peaking in February. We have a pandemic, they come down. The valuations have come down. Now, if you find the right buyer, like in the case we're doing, our valuations really haven't come down. We're looking as an opportunity to not cheat people, which selfishly gives us the opportunity to get good businesses and get them to go with us, right? So you still can find it, it just becomes harder. So that's the thing is, don't try to time. Obviously, don't sell it if you're having 3 bad years in a row. But if you're feeling good, you're feeling strong, solid, take some chips off the table and try to structure a deal where you're still the guy going forward. Where you have a piece of the action.
Right. So if you're still the guy, it's not like a cold turkey, you get your money and you're out. So mentally, it's like a wind down, right? After a good long run on the treadmill, you're still walking, you're still talking to those same clients. You're just not, maybe controlling the equity anymore.
Yeah, and if you get the right partner, and again, I'm only referring to family offices and private equity, but if it's a family office or private equity buyer, they don't want to run your shop. That's the last thing they want to do. They're buying you. So I know in our structure, that's why we make our guys roll 20%. It's not because we need their money. It's because we don't want them to run away, right? So if we give them 20% equity in the deal, there's enough there that we show them, hey, look, you were reinvesting $1 million in your business every year. We're going to plow in 7 or 8 million a year cash every year. We're also never going to take a distribution. So think of all that capital that's going back into your business that you never had before. We're going to explode the business. We're going to give you the capital to explode the business. So that 20%, couldn't that be worth, our goal is to get 4x on that. So in theory, there's a good chance they'll get just as much money on the second bite. So they're incentivized but removing 80% of the risk. So there are partners out there that do that. I think that's a good way for people to look at exiting.
So we're in some interesting uncharted times, right, C-Man, with this whole pandemic. Not sure if it's going away. Not sure if there's going to be a second spike. So how does that affect the business plan and mergers and acquisitions? Can you share some thoughts to our listeners?
Yeah, sure. I think I saw obviously there was a lull in obviously there's a freeze in March and April and May of M&A activity. But I think people have gotten back into it. I thought, without getting into the economy or politics, I think there's been a strong positive response to helping businesses pause. Things like the PPP. You can argue whether they're great or bad, but I can tell you that I think it allowed everyone to take a 2-month breath, relax, gather themselves and get back to work. And I think that's certainly true in M&A. I saw that pause, relax everybody, calm down, and get back to work, and not worry for 2 months. And that 2 months got them back to doing what they do best. And so M&A got back on track. So right now, it's a very busy M&A market again. There's still a lot of capital on the sidelines. The market's at a high, obviously, but even separate from that, there's a lot of capital. It's what drives the market up too. There's just a lot of cash on the side. So M&A activity, people want to put the money to work. I think this is going to be, as far as second spikes, I don't think I've ever seen a year where politics is going to be that big a swing on how people react in the M&A. But we'll have to see what happens post-election. But I think there's going to be M&A activity either way. It's just depending on which direction it goes. Is it going to be opportunistic M&A, or is it going to be bullish M&A?
Right.
So we'll let you know in November.
Yep. Time will tell. So
But it'll be
sticking
busy,
with, what was that?
It'll be busy though.
Yeah.
I think I'm reasonable slow.
Busy is good. Sticking with the pandemic, maybe just some thoughts to business owners out there who, maybe are a little confused, a little struggling. PPP got them by. What do they do? Do they pull back? Do they reinvest in salespeople? Do they beef up advertising? Any thoughts there for what business owners who are struggling are going through?
Yeah, look, it's easy to say because I don't know everyone's balance sheet, but if you have the ability, I think now is a great time for a land grab, right? So you've got capital and you've got the ability to do it. It's a great time to kind of grab those opportunities. I mean, as an entrepreneur and investor, just personally speaking, I'm always looking for opportunities. I mean, now is probably not the best time to buy a shore house, right? But there may be opportunities in other fields or markets. I just use real estate as an example, right? Maybe going into Manhattan is the right time. Taking the risk and doing those things. Again, just on the real estate side. And I think the same thing goes for operating companies. It's an opportunity to do something, right? And maybe bring in some partners, and there may be some weaker competitors or things like that. And that's where M&A comes in too. It could be, you might be looking at maybe you're not ready to sell. Maybe you're looking to acquire. Maybe it's a good time for you to be a buyer. Maybe some businesses are struggling a little bit that are over leveraged and could merge in.
Yeah, it's a great point. For every man's floor, there's another man's ceiling. So maybe there's someone out there who can benefit both parties through that merger or acquisition. Sure.
Yeah.
You touch base on real estate, so I would be remiss not to allow you to speak a little bit about the real estate market and, your thoughts there as to, just in general, but, I'm going to put the pandemic aside here for a minute, just how real estate can help a business owner on their balance sheet.
I look at real estate, and this may be a little jaded from my private equity work the last few years, but it's a hard thing to do. But real estate really needs to be separated from the business. And I always tell people that. People say, well, shouldn't my business own real estate? And I'd say, no, you should own real estate. Your business shouldn't. Real estate's a long-term game. It's very expensive, even though you can maybe borrow at the right number. It can be a burden on the business. And you got to separate. I've always believed in separating the real estate from the business. And I think, it's one of those things. It's a 20-year plan. I don't look at real estate in windows of a year or two. Like a business, you could turn it quickly and you can start becoming profitable very quickly. Real estate, especially, people are on to the fact that you can buy at low cap rates of real estate. So you got to put in the time, just like anything else. But this is a long run. You also have to be able to buy for the long run, and I think that's a big thing with real estate. I mean, I own real estate in New York right now. It's a terrible time to own real estate in New York. Just terrible. Tenants moving out, vandalism, riots. If you're in a major city, it's just not a great time. So I wake up some days I say I want to buy more in New York. Some days I wake up and say I must be insane to buy more in New York. So it's an interesting time.
Yeah, like anything else, it's calculated risk, and real estate markets and all kinds of cycles have upsides and downsides. And, buy low, sell high, right? But I want to bring out an interesting point you said, which I agree with you from my insurance background perspective. You never want to have the operating company or one of the operating companies own the real estate. You want to shelter the liabilities and the equity and the value of the property to an LLC. Pretty much that's the structure most people go. Gives you the corporate shield, but it also segues it from the operating company. And then it's weird, depending on the value of the property and the value of the operating company, the whatever is worth less should indemnify the other, in my point, because that's the way from an insurance perspective. If the operating company is the tenant and it's a big piece of property, you want them to indemnify the landlord for everything. And this way we keep it separate. Yeah. So, let's just circle back to, the business environment in general. Any thoughts to, just, little tricks of the trade that a business owner could do to kind of, on this weekly basis, motivate his team, grow his top line, cut his bottom line? Let's just go on a macro approach as we come down to close here.
Sure. So I have an interesting philosophy about the P&L, and this might help people to do that. I look at my P&L and I look at every line item, and I don't call them expense items. I call them investment items. On my P&L, when I look at my expenses, it's something I've done for the last 15 years. So when I look at an investment, I say, okay, this is an expensive investment. What's my return? My wife, I drive her crazy, says, don't use the word ROI around me again. So I have to remember I can't use that at my house. But when I use it in business, I say, what is this expense about? What is my return on investment on this? Because it's really an investment. You shouldn't look at the things as expenses. So if you take the time, it might seem like a micro task, but it's actually a fairly macro task. If you go through your ledger and look at every single one of your expense items, says, what is my return I'm getting on this investment? The obvious are advertising and marketing. Those are easy. But if you just keep going, right? Office supplies, anything you're buying down there, what's my return? Insurance, what's my return on that investment? I'm making investment insurance. I don't look at insurance as an expense. It's an ROI for me, right? What's my protection I'm getting from that? So same thing. I think you got to look at all these things. Say, what am I getting for this? And there's not one item on your expense list that you should consider an investment, and whether it's a good one, whether it should go away completely or change or be increased. And you can play with those things. Okay, if I increase it, what do I get out of that?
Awesome. I'm going to recap for our listeners here, taking from start to finish in this podcast, everything that Cardie said, because there's so much meat in this podcast, that when you're starting a business, right, you really need to surround yourself with some good advisors, right? Your vendors, accounting, legal, marketing, consulting. You want to be open to understanding, the market you're in, what those competitors or peers are doing for success, and follow that strategy. And then, as Cardie mentioned, once the business takes off, really invest in your salespeople, right? So the business owner always is the major investor and salesperson, and he's got all the skin in the game, but then he has to build his team out of other salespeople and provide the right incentives and the right infrastructure, whether that be support staff, technology, software, et cetera. And then, Cardie took us more along as the business succeeds over the years or decades. What is the end game strategy? Is it to acquire and continue to grow, or is it to look to become a seller? And I think I want to point out here, Cardie mentioned, think about that well ahead of time. You don't want to react just in a bad cycle or a bad couple years and bail. You want to try and hit your peak, and then, think about doing it, maybe well before 65 and retirement age. Maybe you stay on for 2 to 5 years in the runoff, and you probably make the most money that way on the buyout and the additional sales that may be incorporated into that contract. Along the way, if you can pick up some real estate, put it in your personal portfolio, build that personal balance sheet as well as the corporate balance sheet, and that's always going to be a successful move. And there you have it, folks. Cardie took you from being a 17-year-old and just getting, talk about ROI, Cardie, here for a second. Caitlin just got her license yesterday. So I was thinking last night, what's my ROI on that investment? And boy, I think it does become an expense, but you know that very well.
I know. Go off the chart. That doesn't count.
Yeah. The editor might have to say, well, wait a minute, everybody's got to invest in their kids, win, lose, or draw. But you've presented so many strategies for us to focus on, not only on a macro, but a micro level. And I'm definitely going to have you back, buddy, because we didn't scratch the surface on digging deep into some of these other topics. And I'm going to keep picking that brain. But I really want to thank you and all of our listeners out there. Thank you, Cardie, for joining Secret Sauce 365, the podcast where we give the answers business owners question every day. And
thank you, Stan. Have a great day.
You too, buddy. We'll talk to you soon.
Talk to you. Bye.
Bye.
Thank you for listening to another episode of Secret Sauce 365. Your feedback is how we grow, so please leave us a rating and review on your favorite platform. And if you want access to even more great information, go to secretsauce365.com.